Hello and welcome to episode 15 of the Bitlemmas podcast. I'm Watson. I'm here with B Sovereign. And today we're going to be reviewing the General Theory of Employment, Interest, and Money by John Maynard Keynes. The point is not to memorize Keynesian policy slogans. The point is to understand the system model Keynes is replacing. The old story says markets naturally clear, savings naturally become investment, and unemployment is mostly a wage problem. Keynes says that's a special case. In the actual monetary economy, demand, expectations, liquidity, and investment can fail to line up. We'll be reviewing four counterintuitive truths. Classical economics is a special case. Employment is set by effective demand. Saving does not automatically create investment. Liquidity and expectations move the real economy. The high level concept is expected sales, not just productive capacity or willingness to work, determine employment. So, what is this book? It's a general theory of employment in a monetary economy, and we'll break down all of those as we go along. The book claims classical theory is a special case, not a normal case. What we mean by classical theory and the special case we'll get into. The book's method is to connect output, so that's goods and services coming out of firms, employment, we'll talk about that, money, the concept of money, we'll talk about expectations and investment. The book's goal is to explain persistent unemployment without blaming workers first. Well, that seems like a noble goal. So we're going to get into it now.
Yeah. And before we
Mhm.
get into that, I want to say the thing to notice about this book is what it's replacing. It's not what it's actually proposing. The classical model is not wrong inside of its own assumptions. It's a perfectly consistent theory of economy where demand can really never fail. So Keynes' move is to say here that that particular economy, the classical economy, does not exist. You live in the other one, the one where people hoard cash when they're scared, where expected sales determine whether anyone gets hired, and where the system can settle at a level that leaves capacity and workers idle. No reason other than insufficient commitment. So that's the economy that we actually operate in, and this book gives you the diagnostic language for it.
All right, so we're going to talk about what the standard story is and what Keynes says is not the case. So the standard story, he's saying, is a trap. The supply creates its own demand. This is Say's law. What does this mean? Supply being, for instance, if you were to take all of the production costs, so let's say you working and your employer all together, you have these production costs, that's the supply, and your income, and then it creates its own demand. What does that mean? You take your income and you buy things, so goods and services. So saying that supply creates its own demand, saying that production costs go into the production outputs. That's one part of this standard story that he's critiquing. Saving automatically becomes investment. That seems to me, as a non-economist, that seems counterintuitive. It seems like people save. It doesn't necessarily become investment, but he's saying
Absolutely.
that that's what the classic view. He's saying that the classic view is saying that unemployment is frictional. Frictional being things like regulation, voluntary. So saying, oh, the people who don't want to be employed, they're the people that are unemployed are voluntarily unemployed, or a wage problem. So wages aren't keeping up. The wages are too slow, and as the employers decide to increase wages, then that's going to fix the problem. But when people are unemployed, but they want to work, this is involuntary unemployment. They want to work. That's just slow wages catching up. The moral of the standard story, that's the Keynes view, is that he's saying that you let wages and prices adjust, and then the full employment, or you can call it the limiting case of full employment is going to return. There's no problem there. It's just going to fix itself. He's saying that's the standard story. Now, what's the thesis of the book? Employment is not automatically full employment. We're going to talk about what full employment is as we go through. Effective demand determines how much firms hire. Effective demand being expected spending in the future. We'll talk about that. Saving and investment are not joined by a simple automatic mechanism. And then money is not neutral. Liquidity preference, we're going to talk about what that is, and expectations, right? Expectations of what the spending, for instance, is going to be in the future, move real output, output being goods and services.
And I want to add that, I mean, this is a similar structural move that we saw from the dawn of everything with David Graeber, is that the standard story of human progress is a political fiction, not a historical finding. Keynes says that the standard story of market self-correction is a special case, not the general condition. So in both cases, the move is the same. We reclaim the space of possibility that the standard story forecloses. So here the reclaimed space is the economy can fail at the level of total demand. That's not a policy preference. It's a diagnostic possibility that the classical model makes unthinkable.
Okay, some major premises from the book. The classical postulates, so the classical axioms, do not admit involuntary unemployment. But what is he talking about when he says classical postulates, or when he's referring to the classical theory? There's Adam Smith, who we generally say is the creator of capitalism. But then there are his successors. So David Ricardo would be one, John Stuart Mill would be another. And then they talk about, or they have the absence of talking about involuntary unemployment, not to the level of where John Maynard Keynes would like, let's say. So they don't admit this involuntary unemployment. Firms hire to expected proceeds, so what they think is going to be profitable. Again, expected proceeds, expected what they think the spending is going to be in the future, not social need. Obviously, we know about the profit motive. They're not hiring people to give them a higher standard of living. They're hiring in order to make a profit. Consumption rises with income. Consumption, you can look at it as the spending of goods and services for what households do, what households spend on goods and services. You could look at it as the average if you want. It rises with income, but usually less than income. That seems a little counterintuitive because people think about most people living paycheck to paycheck. So what do we mean about when we say that the consumption is usually less than income? We'll talk about that, because that doesn't apply to the people that have most of the money. Investment depends on expectations of spending in the future. Interest, what is interest? Within this context, you can think of as interest as the reward for parting with liquidity, with parting with your cash. We'll talk about that some more. Liquidity preference, what is that? At the high level, liquidity preference is the amount of wealth stored as money, as cash. So that's liquidity. And there's a whole schedule that goes with this. But for the individual, it's the amount of wealth stored as money versus less liquid assets. So policy matters because demand can be too low for full employment. Effective demand effective demand can be too low for full employment. So he's saying that policy needs to be changed in order for, or controlled in order for there to be full employment. 4 counterintuitive truths. Truth number 1, classical economics is a special case. Totally, like B. Sovereign was saying, internally consistent, but a special case. And the general, hence the name of the book, the general theory. I've also heard that he was borrowing from the general theory of relativity in order to make the book seem, more important.
Very interesting.
But
I did not know that.
yeah, so that's truth number 1. Truth number 2, employment is set by the effective demand. So we'll talk about effective demand and this, or what this all means. Truth number 3, saving does not automatically create investment. And number 4, liquidity and expectations move the real economy. We'll get into all 4 of these. Now, classical economics is a special case. Classical theory, again, like we were saying, we're going to more like a David Ricardo and the successors to Adam Smith, John Stuart Mill, others. They assume away the problem that it needs to explain. In Keynes's view, you should be able to explain why there isn't full employment. So that this is something that he is preoccupied with. That's why the name of the book is Money, Interest, and Employment. It treats full employment as the normal limiting case. So saying that prices will just, the market's going to solve it eventually. Everybody that wants to work will be able to work. It reduces unemployment to friction. We talked about friction. Again, friction is some things like regulation, people getting in the way of the market. Refusal, people refusing to work because they're lazy, for instance. Or wage rigidity. So wages not being reflecting or moving fast enough for the employment. So Keynes says these assumptions do not match actual monetary economies. And monetary economies are what he refers to as real economies, where you have the amount of money or currency in the market of one of many things affecting things like expected demand and the interest rates and all of these other things.
Yeah, so I would say that the big issue here with classical first and foremost, I love the refusal to work for people being lazy excuse. That has always been humorous to me. But for classical economics, the danger of a special case theory isn't that it's wrong, right? It's that it's correct inside of its assumptions and wrong outside of them. And you can't tell from the inside which world you're living in. So think of it like the weather model that only predicts sunshine. It's perfectly accurate on sunny days, but the moment it rains, the model tells you the rain is actually sunshine that hasn't adjusted yet. So that's what says law does to unemployment. It doesn't explain it away. It just redefines it as something else entirely. So for builders, this is the same trap as any system that assumes its users will behave a certain way. You can't predict that. If your protocol only works when demand is always sufficient, your protocol only works in the special case, and it doesn't consider any deviations from it.
All right. So let's get into what the special case versus the general case may look like. You have the classical special case here on the left. Flexible wages. So again, you have employers saying, deciding how much people should get paid based off of increasing the wage. When people decide they don't think that being paid the amount of wages isn't enough, they'll increase the wage, and then the market will decide, how much or people will be employed if they, so they'll increase the wage more and more in order to get more people employed. You have Say's law, again, that is where you have supply creates the demand plus the saving. So people, the income, when after they receive their income, that's employer and the workers, they get their income, and then they decide to save. Then that's going to imply, according to Keynes, the classical special case, that's going to imply, oh, there's investment happening, because again, people are taking all of their money and putting it back into the economy and buying things. Then you have the general monetary case where demand can fail. Expected demand, or sorry, effective demand can fail. People, entrepreneurs can believe that the future expected spending is going to be less. Plus, the money, how we'll talk about how the money affects interest rates and so on and so forth in the future, but the money actually matters, and the expectations, all of those bind, again, what John Maynard Keynes cares about, which is the full employment and reaching full employment. Again, full employment meaning everybody who is willing to work for the real wage can work. The firms will hire them. And we could talk about real wage versus what he calls the money wage as well. But let's say looking to say that now, the real wage is based on purchasing power, and not on the money wage is based on the currency units. So real wage, when you see economists talking about the prices of eggs and all that, that's purchasing power, and that's accounted for. So people can say, if you want to measure, or you're increasing the wages and you're doing it, and then there's a massive amount of inflation, people can still say, well, I'm not going to work for that. That's not a real wage. I can't afford eggs. Their eggs are $18. So he counts for that. So when we're talking about wages, we're talking about real wages here. When we're talking about involuntary unemployment, truth number 2: employment is set by effective demand. Firms hire where expected proceeds, expected profits, and future spending justify the employment. Again, an entrepreneur is going to hire now based off of what they expect the spending to be in the future on what they're going to create. Effective demand is the demand point that makes hiring profitable. And we'll talk about this a little bit on the next diagram. More capacity does not matter if the expected sales are too low. Capacity being the ability to produce the outputs. You can think of a factory that can produce 10 cars in a day. That's the capacity. But just because it can produce 10 cars doesn't mean it's going to produce 10 cars. They may produce 2 cars based off of what the entrepreneur believes the expected spending will be in the future. So just because you have a factory that will do that, doesn't mean that they're going to hire the people that to produce the 10 cars, even though they can hire them. And then unemployment can be a demand failure, what he calls a deficiency in the demand, not a worker failure.
Yeah. So here's the sovereign test this book passes, really, is can you explain unemployment without first blaming workers? If your model requires you to say that they just won't accept the right wage, your model has assumed a wage demand failure. Keynes gives us a model where demand failure is possible, and it explains more of what we actually observe. The diagnostic power of defective demand is that it connects a system level variable, expected sales, to a real world outcome, which are hiring decisions. It's not about whether people are willing to work. It's about whether firms expect enough revenue to justify putting them to work. So that's the control point. It's not the wages, it's not willingness, but expected proceeds, which are based on pessimistic or optimistic outlooks of the firm. And if you want proof of that type of economy, that can stay below full employment for a timeline that makes the classical model untenable. You can look at Japan's lost decade that lasted 20 years. They had near zero interest rates. They had idle capacity. So they had the ability to hire on more workers. That workers were willing. There were factories available, and the demand was yet still inefficient to restore full employment. So the classical prescription, which are lower rates, investment follows, was tried. It did not work. The self-correcting mechanism the model relies on simply didn't activate. And that's not just a temporary shock that the market clears. That's the economy settling at a below full employment equilibrium and staying there. So that's exactly what Keynes said could happen, and exactly what the classical model says cannot happen.
All right. So now effective demand. You have expected sales of what's going to happen in the future. This is what the entrepreneur is thinking. You have the cost to employ the people, and the intersection of those two would be the effective demand. So hiring stops at one level, which may be less than full employment, just like what B. Sovereign said. Now, truth number 3, saving does not automatically create investment. What are we talking about here? Individual saving is not a decision to consume. All right, now we're starting to unpack a little bit. So when this is getting back to the Say's law, the idea, I'll go over it again. Supply creates the demand. So the supply is the production. You're creating things. The owner and the workers are creating things. They're going to create, that supply is going to create an income for the workers. The workers are going to have an income. The owner's going to have their profit. That supply. Now, the income is going to create the demand. They're going to spend. They're going to consume. And that's the Say's law. He's saying that no, they may not consume. So investment is a separate decision under uncertainty. People, this is another thing to throw into the mix. People decide when there's uncertainty, they decide to become more liquid. People decide to store their wealth as cash. That's one thing that affects investment. So there's no simple nexus forcing one savings to become another investment. And that's part of his point, is that it's not simple. There's a bunch of things to consider. Investment does not fill the gap. What's the gap? The gap between the consumption and the income. So income and employment adjust downwards when this occurs.
Mm-hmm. And I mean, I wanted to further drive this point home, and I think we can bring up 2020 in that regard. When you see people that are getting laid off from their firms, you're not thinking about, oh man, I should probably make some investments right now at this point, deploy some capital, right? You're more so looking at trying to build a safety net for yourself, because you don't know if you could be next, right? If firms are just letting people go. So yeah, this is where Keynes breaks the thrift intuition, and it matters beyond macro, right? At the individual level, saving is prudent. And at the system level, if everyone saves more and investment doesn't rise to match that, the total demand contracts and everyone gets poor, including the savers. So the unasked question here is, who coordinates the conversion? The classical answer is the market, automatically. Keynes says no one does. It's two separate decisions made by different actors under different information. There's no invisible hand that turns your bank deposit into a factory. The builder implication is direct. In any system where participation depends on ongoing commitment, open source contributions, protocol liquidity, community labor, you cannot just assume that the capacity will automatically convert to activity. You need a mechanism that makes that conversion legible and likely. Or you get the equivalent of involuntary unemployment, willing participants sitting idle because no one made the commitment to activate them.
All right. Now the diagram for the demand gap. So income rising, people getting more income from their job. If investment fills the gap, the output, so that's goods and services, and the jobs hold. We're talking about this demand gap. Now, John Maynard Keynes talks about that this gap with consumption, the level of consumption, rising less than income, that's what needs to be accounted for. So now that the demand gap opens, if investment doesn't rise with it to fulfill the demand gap, then you're going to have expected demand plus the employment falling. Expected demand is people, entrepreneurs believing, again, that that expected spending in the future is not going to be high. So they're not going to hire and employment's going to fall. Now, truth number 4, liquidity plus expectations move the real economy. Investment depends on long-term expectations, and the expectations, a big part of that within this domain is going to be what it is that future spending is going to be. Uncertainty, we talked about this a little bit already, but uncertainty makes people prefer liquidity. They prefer to store their wealth as cash and not in less liquid assets. What happens there? Why is that important? Liquidity preference helps set the rate of interest. The way to think about the interest in this domain is it's the reward for parting with liquidity. So if you see that the interest rate is higher, you have a reward for lending, putting your money in some type of capacity where it can be lent out, right? You forego cash. So that's the reward for doing that. But you have another problem on the other side of that, which is when the interest rate is high, then it becomes more expensive to borrow. When it becomes more expensive to borrow, now you have entrepreneurs not borrowing to invest. So that's the other side of it. We'll talk about this on I believe the next slide, but interest and asset prices shape that's how interest and asset prices shape the inducement to invest.
Mm-hmm. Mm-hmm. And it really makes perfect sense, because interest rates, that's also why the Fed controls them, is because when you increase interest rates, it's really incentivizing people to save, right? Because you're going to get a higher return on your money. When they're decreasing that, it's supposed to make you want to deploy capital for a bigger return. So I want to dive into it, and this is where money stops being a villain and starts becoming a lever. When uncertainty rises, people hoard money rather than invest it. That hoarding is rational at the individual level and destructive at the system level. Investment falls, employment falls, real output contracts, and not because work can't be done, but because no one is willing to fund it. And you don't have to take Keynes' word for it. We can take a very recent example. Last week, May 19th, the 30-year US Treasury bond yields hit 5.197%. And for those of you all who don't know, that is fairly high. This is actually the highest since July of 2007, before the financial crisis, nearly 19 years ago. Why? Because inflation fears from the conflict and the ongoing Iran war has sent oil prices up. The government deficit continues to climb. It's currently sitting at 39 trillion. And markets priced in higher for longer Fed rates. This is the Keynesian cascade in real time. The uncertainty about long-term expectations have risen. Investors are demanding higher yields to lock up their money for 30 years in this environment. They want liquidity, not the duration risk of holding these bonds long-term. which stems from their longer-term investment. So as a result, bond prices fall, the bond yields rise because the bond prices and the yields move inversely. So when demand for bonds drop, the interest rate the government has to pay goes up, which further perpetuates the interest problem that the US currently has. But that higher yield then becomes the hurdle rate for every other investment in the economy because it's the risk-free rate. Because the government has never defaulted. The US government has never defaulted on a payment. We are speaking explicitly to the US right now. It is, the reserve currency. So it's good to talk about what's going on in its market. But to say that we're looking at the 30-year treasuries, right? And this is the risk-free rate from the aspect of default, since they've never defaulted. So since this is used as a benchmark for mortgages and for corporate borrowing, those will get more expensive because then you have to add on default risk on top of that. So it is going to be whatever the 30-year treasury rate is plus, right? So projects that were viable at 4% won't get funded at 5.2%. The real economy contracts, not because the work has disappeared, but because the commitment to fund these longer term projects got more expensive. And that is the liquidity cascade. Again, it just happened last week in real time. We can all see it. So for anyone in this room who cares about the monetary sovereignty, this is really the foundational issue. If money preferences move real output, then who controls the money? And whether that control is discretionary or rules-based is not just a technical detail. It is the entire question, and we need to truly reason with it. Keynes sees this clearly. His answer was to just centralize the lever, and that will bring us to the most important objection in this episode.
All right. So we have the cascade that B. Sovereign was talking about. Uncertainty rises. Liquidity preference, people want to hold their wealth as cash, rises. They want to hold the money. Then the interest and the hurdle rate rises. Remember, interest is the reward for parting with the cash, with the money. So that's a reaction to the liquidity preference. And the hurdle rate rises with the hurdle rate. Again, the amount it costs to borrow. So investment falls because the interest rate rises. Then you have effective demand and employment falling. Again, employment is going to fall if the investment falls. So this is a cascade. Now, policy meaning, this could be for this community more of the controversial slide. Central controls, not total control. It may also come as a surprise because most people believe that Keynes says, they point to him as a complete socialist, complete total control of all production. Banking policy may not be enough to secure optimum investment. Public authority can guide consumption and investment. Keynes argues for socializing the investment, but not all economic life. What does he mean by that? Again, we're talking about the specific things like the monetary policy, the interest rates, and those things, but he's not talking about the markets themselves. So the goal for Keynes is full employment while preserving efficiency, freedom, and initiative. And again, the idea of full employment, the misconception is that full employment means everyone's employed. No, it means that every worker who is willing to work for a real wage is employed. So that's what that means. Now, here's the argument for this community as well, where we bring home what is the big pushback on Keynes. We talked about employment. And we said that it's set by effective demand. The entrepreneurs who are doing the employing, they are going to employ based off of what they expect spending to be in the future. Effective demand requires investment. Investment moves with interest and expectations. Remember, interest is on one side the reward for parting with liquidity, because that has an effect on one side, and we'll talk about in the next premise. It's going to pull the interest rate up because we're trying to pull and make it so that there can be less people holding money as cash. And expectations, we talked about that with what it is that the spending is going to be in the future. Then you have interest depends on liquidity preference, which I was saying, plus monetary quantity. So this is two sides. Liquidity preference is the demand for cash, people saying, I want to hold cash. Money quantity is on the other side. That's the supply of the cash. So interest is going to be set by both of those. Money quantity and cash terms are set by the monetary authority. So now you have the argument for the monetary authority. Full employment policy, therefore, implies centralized monetary authority. The caveat is that Keynes is not saying print everything, and he says that liquidity preference and inflation, both sides of that can destroy or break this whole chain. You could have the liquidity cascade if you do a print forever. So that's a problem. But the objection is that it's a governance choke point. The Cantillon effect. The people closest to the money printer are going to be able to exploit this system. That would be what one of the pushbacks for us.
Yep. And I think that arguably this is why I think that this is probably why this slide matters the most, right? And we're just going to reiterate here real quick before we dive in. So Keynes' causal chain is correct, right? Employment depends on effective demand. Effective demand depends on investment. Investment depends on interest and expectations. Interest depends on liquidity preference and money quantity. And money quantity is set by a monetary authority. And for anybody who has sat through a macroeconomics class, I feel your pain, because it's nothing but charts and shifts the entire time. But the chain is sound. The conclusion follows. If full employment is your target, you need someone setting the monetary terms, right? And here is the proof that even classical practitioners know this. We are going to take into consideration the pandemic once again of 2020. When the demand had collapsed, no one seriously proposed letting prices and wages adjust. That would have been painful for everyone. Everyone from self-described free market economists to central bankers reached for the demand side lever. So what happened? Stimulus checks, right? We had PPP, payment protection program loans, which were both fiscal acts, right? And then you have quantitative easing, which is a monetary act. That's monetary stimulus or quantitative easing, of course. So the entire policy establishment acted like Keynesians in a crisis, because the alternative, which was waiting for the market to self-correct, which again would be entirely painful and unpalatable for everyone, was politically and economically not sound. So that's not a theory, that's what actually happened. But here's the tension that Keynes acknowledges but doesn't resolve. And Watson had just brought that up, is that the same lever that stabilizes employment also concentrates governance power. It has discretion, it has capture risk, and it has abuse potential, right? The stabilizing lever is also the choke point. And this is not just a pitfall, it's a genuine design problem, right? Keynes diagnoses the system correctly, but his fix introduces exactly the kind of power concentration that creates the next failure mode. So the question for builders is, can you get the diagnostic benefit of effective demand without the governance costs of a discretionary monetary authority? And that's the design problem this episode leaves you with.
All right. Now, as far as a critique of the book itself, we have the next few slides. So, this first slide here, we're going to talk about the domain, the language that Keynes uses. And you can kind of imagine if you're trying to model some type of problem or Keynes's problem, full employment, and you're trying to provide, let's say you're trying to provide a parallel economy, software that facilitates a parallel economy, and you're trying to do it from the bottom up. The idea is you create a language and solve a problem inside the language. How would you do that? You would need to isolate the primitives, how you compose those primitives, and the major methods of abstraction. So the primitives within this domain, you have income, consumption, saving, investment, interest, and employment. And then you could say, again, the fictional, idea or challenge would be, we'll create a parallel economy. We're trying to create a software that facilitates a parallel economy. So you need to be able to account for how you compose the primitives. Consumption gap, we talked about that, the gap between consumption and interest. The investment response, and the concept of a multiplier, which is basically a feedback mechanism that you get more out of it than what you put in, basically. So these are things when you're composing the primitives, you can have some type of behavior that supervenes on top. Then the abstraction, you can think of a fundamental method of abstraction within a domain as the workhorse or the thing you reach for that can solve the problems within the domain. So effective demand, we know, is what Keynes is preoccupied with, effective demand and how that affects full employment. So having that realizing that as a system level control point and being able to reason about the system or communicate with others on how you would solve that problem. Again, Keynes, within this way of thinking about software craftsmanship and building a language to solve a problem, within this domain, you never want to analyze money, expectations, and output separate from one another. And that's something that you would derive from this language analysis.
All right. So what this book reveals is that effective demand is the system level control point. It's not supply, it's not willingness to work. The classical model is a special case that assumes away the coordination failure it needs to explain the same monetary level that stabilizes employment, concentrates governance power, discretion, capture risk, and abuse potential. Liquidity preference connects uncertainty to real economic outcome. Money is not necessarily neutral, and saving and investment are separate decisions coordinated through income adjustment, not automatic conversion. So, what is the primary choke point that Keynes identifies in the monetary economy? It's the monetary authority controls the terms on which liquidity is supplied, which cascades through the interest investment and effective demand to employment, right? And the Bitcoin room objection to Keynes' monetary authority application is the same lever that Keynes wants for employment stabilization becomes a centralized governance choke point with discretion, capture risk, and again, abuse potential. So the exit path from the monetary authority choke point would be a monetary base with no discretionary issuer, a fixed supply, no governance choke point, while preserving the Keynesian diagnostic language for understanding demand failures, right? So with this information, what should we build? Question that we've all been waiting for. We should build protocols where effective demand is visible, not assumed. Investment coordination that doesn't require a central authority to set monetary terms. So we can use this with things on chain now, right? If you have to mint coins, right, for your blockchain to exist, and that is created by a central authority, right? Most cases, it's the DAO. That's something that you should probably look at and reason with if you're okay with that. Demand legibility tools, visible commitments, visible liquidity, and visible expectations. And you want to have monetary based layers with no discretionary issuer, removing the governance choke point Keynes identified. Systems where the demand signal reaches participants before capacity dies idle. So if we're building a monetary protocol, we want to avoid the discretionary supply and control issuer, and we want to adopt a fixed supply. We've mentioned that. We're just really driving that message home here. If we're building an investment platform, you want to avoid hidden expectations and opaque commitments, right? Adopt visible demand signals. Everybody, again, I think transparency and visibility are what or will be the success to decentralized anything. Truly decentralized, price aligned, and for that model, we can go over that again. So it's no pre-mine, no roadmaps, no issuer, and no censorship. Okay. So you want to adopt for an investment platform visible demand signals, transparent funding flows, and pure visibility. For governance mechanisms, you want to avoid a monetary authority on a single lever, right? And you want to adopt distributed control over multiple levers. And if building a community economy, you want to avoid demand invisibility, and you want to adopt multiplier-aware designs, visible liquidity. And I want to give some price-aligned tech examples. So the first would be Bitcoin, right? It's the direct price-aligned answer to monetary authority's choke point. It has a fixed supply. There's no discretionary issuer. Its rule-based supply schedule removes the exact choke points that Keynes identifies. Again, we have Lightning, which is just the layer 2 to Bitcoin, and it almost replicates the exact same distributed infrastructure, and it makes demand legible at the payment layer. Payments are visible commitments. There's no mandatory routing hubs. Users can close channels and exit to layer 1 without intermediary permission. This is directly addressing the make commitments visible builder implication. And then we have Fedimint, which distributes the monetary authority across a federation rather than concentrating it. You have eCash notes redeemable to Bitcoin layer 1, which, again, that is an exit. But the Federation Mint is a quasi-issuer, and Federation consensus can refuse services. So there is partial price alignment there, but it maps onto the exact Keynes tensions, which is distributing authority without eliminating it. And the last tech here that we have is Nostr. It's not monetary, but directly addresses demand legibility. Key pairs have no issuer. Content is censorship resistant across relays. Exit is trivial with identity intact. Shows that making commitments visible doesn't require a central coordinator. And I want to bring up some anti-examples since I'm giving you some quality examples that are price aligned. These are what price aligned technologies are responding to. The first would be CBDCs, central banking digital currencies. There is a central issuer. They are central by design, and I mean, there really isn't much of an exit there. But the logical endpoint of Keynes' monetary authority implication is taken to its full here with CBDCs. And another one would be, for example, stable coins. They fail. So because issuers can freeze them, they fail C because they are indeed censorable. And I mean, it's again, it can be difficult to exit those as well because issuers can block and freeze wallets. So this proves Keynes' point about monetary authority having discretion.
All right. Now, our third lens that we'll use to critique the book as far as a builder, from a builder standpoint, is builder usability. And like B. Sovereign was saying, we want to make the demand legible, make commitments visible. Commitments to what? Commitments to spending. Who will buy, fund, hire, or maintain? All of those things, because if an entrepreneur can see them from the expected, right, spending in the future, all of those things, they can make decisions immediately that and do things like hire and increase capacity. Make liquidity visible. Who can wait because of uncertainty or what have you, and who needs cash now, right? So people, again, remember, if people are more liquid, that means one of the things is they're thinking that they don't like the uncertainty of what they believe the expectations of the future. Make expectations visible. What futures each actor pricing in? And make feedback fast. Demand signals should update plans before capacity is reduced. You can think of this as a way to build the software for a fictional parallel economy. You're going to have to wrestle with all of this nomenclature, all of this demand. And when you think about full employment in a parallel economy and the digital economy, you still have that problem. You have agents, people wanting to work, and you're trying to maximize, let's say within this domain, you're trying to maximize the amount of people who want to work, that they can find work. So questions to contemplate. Where do you assume supply creates demand in your own work? Right? This is the Say's law. What demand signal would make idle capacity become real work? And where does liquidity preference show up outside of finance? Where are people storing their wealth as cash or storing their wealth as something maximally liquid? What would a full employment design principle mean for builders? We're trying to address some of these things. Now, the conclusion, classical theory is a special case, not destiny. Employment depends on effective demand. Saving needs investment to become employment. Money, uncertainty, and ideas change real outcomes. And the final builder question, what makes useful work become funded work?
Yeah. All right. And so now for the practical move. I mean, really, demand failure is often invisible because everyone is talking about supply, talent, roadmaps. But a Keynesian builder lens asks the opposite question: where is the actual commitment that turns capacity into work? So here is the one model, one story, and one action for this episode. The one model is effective demand is the system level control point, not supply, not willingness to work, expected proceeds that make hiring or funding or contributing worth doing. The one story is that is the liquidity cascade. Uncertainty rises, people hoard money instead of investing it, which is sound. Investment falls, employment falls, real output contracts, not because work can't be done, but because the commitment to fund it does not exist. And this is not a macro story only. It plays out in open source projects, protocol ecosystems, and community economies, right? Parallel economies, anywhere that useful capacity sits idle because the demand signal isn't reaching the people who could act on it. So the one action is run a demand audit. For the sovereign curious, ask 3 questions in your own work. Where is the commitment that turns my capacity into work? What future is each participant pricing in, and where is the liquidity gap between who can wait and who needs cash now? Find one place where the demand signal is missing and make it visible. For system builders, the user demand legibility checklist. Use the demand legibility checklist as your design brief. And when you build a protocol, a community, or an economy, ask, can participants see the commitments exist? Can they see where liquidity is tight? Can demand signals update plans before capacity dies idle, right? It's all about the transparency, right? And the decisive question is, who controls the monetary terms, and is that control discretionary or rules-based? Again, we're really aiming for rules without rulers. So build systems where effective demand is visible and not assumed.
All right. If you have any comments, be sure to leave them in the comment section, and don't forget to visit bitlemmas.com, where we have past episodes and other information, and we'll see you next time.
All right.